Welcome to the Opening Bell Report.
12.68%. I mean, let's just put that number right on the table before we do anything else.
It's a scary number.
It is. February 4th, 2026. We're talking Energy Fuels, ticker UUU. And it didn't just, stumble. It practically fell down a flight of stairs, dropped $3.11 in a single trading session to close at $21.42.
It was ugly. There is absolutely no sugarcoating a double-digit drop in one day. If you opened your brokerage app that afternoon, it was just a sea of red.
And let's be honest, that visceral reaction kicks in immediately. You see that red candle, your stomach drops, and your thumb starts hovering over the sell button. It's that fight or flight response.
Absolutely.
But before anyone does anything rash, we need to hit pause. Because we have an analysis report on the desk today. It's titled The Bull Case for Energy Fuels that looks at this exact same chart, this exact same crash, and sees something completely different.
That's right. The core thesis of the analysis we are deep diving into today is that this drop isn't a disaster. It is a gift. They are arguing that what looks like a crisis to the emotional investor is actually a strategic entry point for the rational one.
Okay, a gift. That is a bold way to describe losing over $3 a share in, 6 hours? But that is the mission today. We're going to unpack why this report believes the fundamentals completely contradict the price action.
We are. We're going to look at the moat, the hidden tech play inside the company, and this massive AI macro trend.
But first, we have to talk about the flash sale concept. Because, that sounds a little bit like marketing spin.
It sounds like spin, but to understand the sale, you have to remember the sticker price just a week or so ago.
Right. Context is everything. Where were we before the floor fell out?
Exactly. We aren't looking at February 4th in a vacuum. You have to zoom out. Just days prior, Energy Fuels had rallied up to nearly $28. It was parabolic.
Oh, it was absolutely flying. I remember seeing the chatter about it breaking 30 any day now.
And the logic the report uses is incredibly simple, but it really stops you in your tracks. If you liked the company at $28, if you thought it was a solid business with a bright future at that price, why on earth would you hate it at 21?
Well, because losing money feels bad. That's the human reaction.
Oh, yes, obviously. But logically, think about it. You are buying the exact same assets, the exact same machinery, the exact same future contracts.
Nothing about the business changed.
Nothing changed overnight. The management didn't quit. The mine didn't collapse. The only thing that changed was the price tag. You're getting a roughly 23% discount from the recent highs.
So this is the classic sentiment versus fundamentals battle.
Precisely. The fundamentals, the actual engine of the business, are intact. The sentiment, how the market felt about it that specific day shifted. And the report argues that when sentiment shifts without a fundamental break, that's where alpha is generated.
That's where you make your money. It's that disconnect.
It's the disconnect.
Okay, but I want to play devil's advocate here. We hear buy the dip all the time. It's practically a meme now. But sometimes the dip just keeps on dipping. If I'm going to try and catch a falling knife, I need to know there's a floor, there's a moat protecting this business so it doesn't go to zero.
And that is where the report spends a massive amount of time. A place called White Mesa.
White Mesa.
Yes. If you take nothing else away from this deep dive today, you have to understand White Mesa. It is the crown jewel. It is the reason this company is valued the way it is.
It sounds like a secret government facility in a movie. The White Mesa Project.
It's actually more important than that to the U.S. energy grid. Here is the fact that matters. The White Mesa Mill in Utah is the only fully licensed and operating conventional uranium mill in the United States.
Can we pause on only? Because that feels like an exaggeration. We're the United States. We basically invented nuclear power. There are no other mills.
In terms of a conventional mill that can take raw ore and process it into yellowcake, no. That is it.
Okay, so explain that distinction. What about other uranium companies?
There are ISR plants, that's in situ recovery. It's a chemical process where they inject a solution into the ground to dissolve the uranium and then they pump it up.
So no big pit in the ground.
Exactly. And it works, but only for specific types of geological deposits. But for conventional hard rock mining, where you dig up rock, crush it, and process it, White Mesa is the only game in town.
That sounds like a monopoly.
It is a massive strategic choke point. Think about the geopolitical landscape we're in. The report highlights a bull argument specifically regarding Russian uranium.
Right, the potential bans, the sanctions, supply chains getting cut off. We've seen that rhetoric ramp up significantly.
Exactly. So if the U.S. decides it needs to be energy independent, which is clearly the way the wind is blowing, we have to process our own uranium. So imagine you are a junior mining company. You find a great deposit. You dig up a bunch of ore. It's sitting there in a pile. What do you do with it?
I assume you process it.
You can't. You don't have a mill. You can't just build one in your backyard. You have to send it to White Mesa.
So Energy Fuels is the toll booth.
They own the toll booth. And it's a toll booth that is almost impossible to replicate.
Why impossible? If uranium is booming and the price is going up, why isn't everyone breaking ground on a new mill tomorrow?
2 words. The NRC, the Nuclear Regulatory Commission. The regulatory hurdles to license a new conventional mill in the U.S. are, frankly, a nightmare.
How long are we talking?
The report estimates it would take 10 years minimum to get a new mill from concept to operation.
10 years.
Minimum. And that's assuming everything goes perfectly. That's assuming you don't get sued by environmental groups every single step of the way, which you absolutely will.
So even if a competitor had $1 billion in cash today, they are a decade behind.
A decade behind, at least. Energy Fuels is sitting there, fully licensed, fully staffed, and operating right now. That is a moat you can't just spend money to cross. You can't buy time.
You can't buy a retroactive permit from 10 years ago.
You can't.
Okay, so that's the uranium story, the old energy play. Dig rock, crush rock, make fuel. It makes sense why that's valuable.
Yeah.
But the report pivots to something else here that I found really surprising. They call it the 2-for-1 special. And this seems to be where a lot of the market confusion comes from.
This is the hidden value.
Right.
This is where the deep dive gets a little technical, but it's crucial to the valuation. Most competitors, companies like Cameco or Denison, they are pure uranium plays. You buy them, you are betting on nuclear power.
Simple enough.
Energy Fuels is different. They are using that same White Mesa mill to process rare earth elements, or REEs.
Okay, so I need you to define RDEs for us. I haven't looked at a periodic table since high school chemistry. What are we actually talking about here?
We are talking about elements like neodymium and praseodymium. We usually just call them NdPr.
NdPr sounds like a droid from Star Wars.
It's less sci-fi and more industrial necessity. These are the critical ingredients for high-strength permanent magnets.
And where do we use those?
Everywhere that matters for the future economy. Specifically, the drivetrain motors of electric vehicles, and the generators inside massive wind turbines, advanced missile guidance systems. You cannot build a high-tech green economy without these magnets. It is physically impossible.
So holding this stock gives you exposure to the nuclear renaissance and the EV supply chain.
Correct. But here's the kicker, and the report makes a really big deal of this. Currently, China dominates the rare earth processing market. I mean, like 90% plus.
The total stranglehold.
Yes. And the Western world is desperate for a non-Chinese supply chain.
And Energy Fuels can just do that at a uranium mill. Isn't the chemistry totally different?
That is the magic of White Mesa. It turns out one of the best sources for these rare earths is a mineral sand called monazite.
Monazite. Got it.
The problem with monazite, and the reason most processors can't use it, is that it is slightly radioactive. It contains naturally occurring uranium. So normal chemical plants can't touch it. They don't have the licenses to handle the radiation.
But White Mesa does.
Exactly. They are a uranium mill. They want the radiation. So they can take this monazite sand, extract the uranium for their nuclear business, and then process the rare earths for the EV market. It is arguably the most efficient rare earth supply chain outside of China.
That actually really clever. It's turning a bug into a feature. The radioactivity is a liability for everyone else, but a bonus for them.
Right. And the analysis suggests the market has no idea how to price this. Is UU a mining stock? Is it a tech materials stock? That confusion creates volatility, but it also creates what the report calls a free option.
A free option.
You are basically paying for the uranium business and getting this burgeoning rare earth giant for free.
I love that framing. Buy the nuclear plant, get the EV factory free. But let's zoom out even further, because even with a monopoly mill and a side hustle in magnets, you need demand. And the report points to a massive macro tailwind. They call it the AI energy factor.
This is the big picture. This is the super cycle. You simply cannot talk about uranium anymore without talking about artificial intelligence.
It seems like we can't talk about anything without talking about AI.
But connect the dots for me. How does ChatGPT affect a mine in Utah?
Electricity. Pure and simple. The amount of power required to run the data centers for training and running these AI models is staggering. We are talking about doubling or tripling the energy consumption of these tech giants in the next decade.
And I assume they can't just plug into the regular grid for that.
They can, but they have a problem. Microsoft, Amazon, Google, they all have these very public, very strict net zero carbon goals. They cannot just burn coal or natural gas to power their servers if they want to keep their promises.
So they go to wind and solar? That's the Senate Green answer.
They try. But wind and solar are intermittent. The sun doesn't always shine. The wind doesn't always blow. A data center needs what we call baseload power. It needs to be on 247, 365 with zero interruptions.
Yeah.
If the power cuts for a second, the compute stops. The model crashes.
And the only thing that is carbon-free and runs 2047 is nuclear. Exactly. So now you have these trillion-dollar tech companies effectively hunting for nuclear power. They're signing deals directly with power plants. And the report makes it clear this creates a structural deficit. The demand is skyrocketing, but the supply of uranium is inelastic.
Inelastic meaning slow to change.
Very slow. Remember that 10-year timeline to build a mine. You can't just flip a switch and get more uranium because Amazon needs it next Tuesday.
So we have a supply crunch meeting a demand shock.
That is the textbook definition of a bull market. And Energy Fuels is unique because of their speed to market. While other companies are filling out paperwork, Energy Fuels is filling barrels. They have inventory on the ground. They have the mill running.
That's a huge advantage, but I have to play devil's advocate again.
Right.
Everything you just said sounds amazing. Moat, tech demand, monopoly. If the story's so good, why did the stock drop 12% on February 4th? Why did the market punish it?
That brings us back to the technicals. The report calls this a healthy reset. And I know when you're losing money, healthy is the last word you want to hear.
It sounds like a doctor telling you the surgery is good for character.
Right. But look at the chart. The stock went from a low of $3.20 to nearly $28 in roughly a year. That is almost a 9x return.
A 10-bagger, almost.
Yeah.
Okay, when you put it that way.
In financial markets, nothing goes up in a straight line forever. Gravity exists. The report points to the RSI, the Relative Strength Index. It's a measure of momentum. When the RSI gets over 70, a stock is considered overbought.
And it was overbought.
It was flashing red hot. There was too much
Froth meaning just hype.
hype, chasing, people buying just because it went up yesterday. What happened on February 4th was the steam being let out of the pressure cooker. It flushes out the weak hands.
Weak hands being the people who panic sell.
Exactly. The people who don't know about White Mesa, the people who don't know about the REEs. The report argues this drop allows institutional money, the big pension funds, the hedge funds, to enter at a more reasonable price. They don't chase the top. They wait for a flush like this.
And the report identified a specific support range, didn't it? Where do they think the bleeding stops?
They're looking at the $20 to $21.50 range.
Which is exactly where we closed.
Right where we close. Technical analysis isn't magic, but it is psychology. This is a natural area where buyers have stepped in before. It's a potential floor. The stock can catch its breath here before the next leg up.
Now, there's one more criticism we need to address. I see this on the message boards, and the report tackles it too. Valuation. People look at the price-to-sales ratio and say, hey, Energy Fuels is expensive compared to the revenue they're booking today.
That's a valid metric, but you have to compare apples to apples. If you think UU is expensive, what are your alternatives in the uranium space?
Mostly junior miners, I guess. Penny stocks.
Right, junior miners. And let's talk about what that actually means. A lot of these companies are just a PowerPoint presentation and a plot of land in Saskatchewan. They have no revenue, they have no mill, they have no permits. They are highly speculative lottery tickets.
Basically just an idea on paper.
In many cases, yes. Contrast that with Energy Fuels. They have over $100 million in cash and marketable securities. They have inventory. They have the mill. The report calls this the security premium.
So you pay a higher price for the certainty that the company will still exist in 5 years.
Exactly. In uncertain economic times, investors flock to quality. You paid up for safety. It's a difference between buying a house that's already built versus buying a blueprint from a guy who says he knows how to lay bricks.
That's a great analogy. So let's bring it all home. We've got the context of the drop. We've got the White Mesa moat, the hidden rare earth business, the AI energy demand. What is the verdict? What's the action plan for the listener staring at that red number in their portfolio?
The verdict from the report is clear. The drop is noise. The long-term signal is a secular uranium bull market where Energy Fuels is the king of U.S. uranium.
King of U.S. uranium. No pressure.
Well, it's a title earned by infrastructure. The strategy the report suggests is threefold. Number one, don't panic sell.
Emotion is the enemy of the portfolio.
Always. If the thesis hasn't changed, don't change your position. Number two, dollar cost average, DCA.
Explain that for anyone new to this.
It just means buying smaller amounts over time to smooth out your entry price. The logic is simple. If you thought $25 was a good price to buy, $21.42 is mathematically a better one. You use the dip to lower your average cost.
You treat the stock market like the grocery store. You stock up when steaks are on sale.
That's it, exactly. And third, watch the level. Keep an eye on that $20 mark. As long as the stock holds above that support zone, the long-term uptrend remains intact. If it breaks below, then you reevaluate. But right now, the structure is bullish.
And the report ends with a quote from the Oracle of Omaha himself, Warren Buffett. I feel like no finance deep dive is complete without a little Buffett wisdom.
It's a classic for a reason. He said, the stock market is a device for transferring money from the impatient to the patient.
That really hits home on a day like February 4th.
It does. This 12% drop. It is a test. It is literally a test of your temperament. It tests whether you're the impatient investor who sells because the line went down, or the patient investor who understands the value of the asset, the mill, the licenses, the strategic importance, and waits for the market to realize it again.
It's easy to be patient when stocks are going up. It's profitable to be patient when they're going down.
Well said.
So here's a final thought I want to leave you with. Something that struck me while reading all this technical data. We talk about the future constantly. AI, electric vehicles, the digital age. It all sounds so abstract and clean.
Clouds and software.
Right. But to power that clean digital future, we are literally digging into the earth for heavy metals. We're going back to the periodic table. We are relying on rocks and mills and old school chemistry.
It's the convergence of the oldest resources and the newest technology. The cloud is actually made of copper, lithium, and uranium.
Exactly. If AI is the brain of the future, uranium is the food that keeps it alive. And if that's true, does that make a mining company like Energy Fuels more of a tech-adjacent play than we give it credit for?
That is a fascinating way to look at it. It blurs the line between resources and technology. It might just be the most important infrastructure play of the next decade.
Something to mull over while you watch the charts?
Yeah.
Ask yourself, are you the impatient or the patient? Thanks for diving in with us. See you next time.
Don't forget to like, share, and subscribe for more.